Good morning, everyone. It's great to see you all here. Thank you so much for coming today or for joining us on the webcast. I'd also like to say thank you for all of your support of Intuit over the last year. We've gone through a lot of content this morning, so thank you for your attention, and we're almost to the Q&A section. So I hope you found the platform immersion experience helpful for understanding how we're solving some of our customers' most important problems as we move towards becoming an AI-driven expert platform. I'm going to share how this strategy translates into our financial results, and most importantly, how our financial principles continue to guide our thinking. So let me start, as I have in the past, with a look back. Now, on the left side of the slide, you'll see the key points we closed with at last year's Investor Day. The right side shows how we performed during fiscal 2019 against that opportunity. Our performance in 2019 was strong across each of our businesses, with 13% revenue growth at the company level. Our two main online platforms, QuickBooks and TurboTax, are now $3.9 billion and growing over 23% combined, with small business online ecosystem revenue growing 38% for the year, which is well ahead of our expectation of better than 30% growth. Strong revenue drove double-digit GAAP and non-GAAP operating income growth, and we remain pleased with our ROIC and the consistent dividend increases we've been able to provide. Overall, a really great year, and I couldn't be more proud of the team that delivered these results in fiscal 2019. Now, Sasan shared our total addressable market earlier, and I'd like to share proof points that our strategy is working and positions us well to penetrate our nearly $250 billion addressable market. We saw strong traction across our platform in fiscal 2019. First, we see a long runway ahead for our core QuickBooks Online and TurboTax Online products. We have strong growth in the core, with our online ecosystem revenue growing 38% in fiscal year 2019, and TurboTax growing 11%, the second year sequentially of double-digit growth. We're focused on solving the biggest problem our customers face, which is confidence, by connecting them with experts in both tax and small business on our live platform. Second, we continue to build out additional solutions for our customers here in the US to solve even more of their problems, which include getting paid, accessing capital to grow, making ends meet, and paying off debt. We saw strong growth in our payroll and payments businesses this year and are seeing continued success with T-Sheets. QBO payroll grew 35%, QBO charge volume grew 40%, and the number of customers on the T-Sheets platform grew 60% to 1.2 million. And in the consumer group, we're seeing great interest in our Turbo product as we build out our consumer finance platform. As we've shared following last year's tax season, we have 14 million registered users on the Turbo platform. Now, third, we remain focused on expanding outside of the US, where subscribers grew 58% last year to be 28% of our QBO subscriber base. This strong QBO sub growth was driven by the UK, Australia, and Canada, where we've achieved product market fit. And we're seeing progress in markets like France, where new innovations are saving customers hours of time each month. Now, we use our financial principles to guide the decisions we make, and these should look very familiar as they remain unchanged from a year ago. You should know that we challenge and discuss them each year as we go through our 3- and 1-year planning process, and we reaffirm them as a management team and confirm them with the board. Now, let me provide a little bit more color and context on each one. First is double-digit organic revenue growth. We continue to see a large opportunity ahead in serving consumers, self-employed, and small businesses to grow the company's revenue double digits as we solve a broader set of customer pain points. Next, we focus on growing operating income dollars faster than revenue. It's good discipline for us to approach each year with expenses growing slower than revenue. As we've said, we manage margins at the company level, so I wouldn't focus too much on small changes you might see in the operating margin of a business unit, given the leverage we get from cross-company platform investments. Now, we've been asked if we're targeting 50 to 100 basis points of margin expansion each year. We are instead focused on operating income dollar growth, as I said a minute ago. Our focus is on driving durable double-digit revenue growth by solving a wider range of customer problems rather than driving towards a particular level of annual margin expansion. Next, we deploy cash to the highest yield opportunities, targeting a 15% ROI over 5 years. This principle is key to managing our business for both the short term and the long term. Whether we're looking to expand QBO internationally or as we invest in our expert platform to deliver more confidence for our customers across our businesses, this threshold is key to making all internal investments that will deliver for years to come. We also apply this same hurdle to any acquisitions that we may consider. After this, we return excess cash to shareholders. This speaks to our stewardship of how we handle the capital we generate and comes in the form of buybacks and dividends. On share repurchases, we utilize a smart grid to achieve a rate of return over time that exceeds our own cost of capital. And finally, we manage to a conservative investment-grade balance sheet that can sustain our business through all types of economic cycles. This has served us well in the past and actually lets us lean in during downturns to emerge even stronger on the other side. Now, I mentioned in my opening that the QBO and TTO platforms are driving accelerated revenue growth, and we expect this will remain the case going forward. In 3 years, we expect approximately 70% of our revenue to come from these offerings. And our desktop offerings remain very profitable, which allows us to invest in new products and markets around the world. As we've shared before, a large amount of the revenue we expect to see in fiscal 2020 will come from existing customers, which means we have a highly predictable revenue model. In fact, we expect about 80% of our revenue this year to come from customers that we already have or who are expected to return based on past behavior. Additionally, our products are needed by customers in all economic environments, which has helped us to remain resilient during some of the prior downturns. Underpinning our growth expectations is our ability to continue adding new customers across our businesses. And this provides an opportunity to serve a broader set of customer pain points across a larger customer base. Starting in small business, you'll see a summary of the customer opportunity. In QBO, we still have a large runway ahead of us in the US as well as internationally. As Alex said earlier, we're focused on delighting customers, providing the services customers need to make QuickBooks the center of their business growth, and expanding our platform and scale internationally. This is all in service to moving from being the source of truth for our customers' books to the source of truth for their business. As we've said before, we expect total subscriber growth to moderate as we place a greater focus on additional services. You've already seen the initial results with recent acceleration of our online services, and we continue to focus on monetizing our customer base while also adding new customers. On the right side, you'll see total paying customers. This includes QuickBooks Online, our desktop subscribers, and desktop unit sales. Once again, our total net adds grew in fiscal 2019. And our desktop base remains relatively sticky, and we're seeing the majority of the customers who are new to QuickBooks choosing QBO. Moving to the consumer group, Greg shared how we're focused on growing our share of total tax returns. This past year, we're pleased to drive growth in the do-it-yourself category, as well as our share within it. Our investment in the free experience was very well received by our customers. And as we focus on transforming assisted, TurboTax Live opens up the $20 billion assisted segment of the tax prep market. Our TurboTax Live customers tripled versus the prior year, with the product now a meaningful revenue contributor to our business. As Greg and Alex shared, we have a strong monetization model across our platform. TurboTax is there for our customers as their financial lives become more complex. Our customers may evolve from a lower priced or even free offering in the first years of their filing their taxes, and that may move into a product like Deluxe or Self-Employed or TurboTax Live as their needs change. And along the way, we can add value with other offerings like our Max Bundle or personalized offers for credit card or mortgage products in Turbo. We have a very similar model in our QuickBooks business, where the platform flexes to each customer's journey. In addition to our QBO platform, where customers can scale from an accounting product like Self-Employed or Simple Start, all the way up to the mid-market with QBO Advanced, services like payroll, payments, and QuickBooks Capital also scale and add value as our customers grow. At the end of the day, everything we do is customer back. There are a wide variety of customers in each of our businesses, and we're focused on serving them in a way that solves their problems, provides them value, and gives us the opportunity to monetize in different ways. However, customer counts are less useful as a way to understand short-term revenue, so we plan to share detailed customer numbers annually instead of quarterly. We're therefore making a few changes to our disclosure. First, we will no longer be reporting customer metrics on our quarterly fact sheet. And second, we're changing the timing of when we report tax units and plan to do so only on our fiscal Q3 earnings call in May. Now, across all of our businesses, we're able to improve monetization as we increase the value we're providing to our customers. ARPC is not something that we manage to. It's the output of the various decisions we make regarding customer and revenue growth. Now, that being said, we recognize that it is a key input for many of your models. So looking at QBO worldwide, we saw an increase in our ARPC this year, driven by our US business, which was partially offset by growth in QBSC and the non-US business. Going forward, we expect QBO worldwide ARPC to increase. This will be driven by our maturing customer base in the US and increased monetization via online services and new product innovations like QuickBooks Live and QBO Advanced. Outside of the US, we expect to see an increase in ARPC from our maturing base and lower promotional activity. Turning to QuickBooks Desktop, we see an increase in ARPC due to strong growth in our enterprise solution, which we expect to continue. And in consumer tax, we saw another year of strong ARPC increases due to the contribution of TurboTax Live and product lineup adjustments for the new tax legislation. This was offset by our investment in the free experience. We expect growth of our TurboTax Live offering to continue to drive ARPC higher. Durable revenue growth and disciplined investment have driven our operating income growth historically, and we remain focused on both going forward. So walking down the P&L, gross margin has been stable in the low to mid 80% range, and we expect that that will continue. Sales and marketing is an important area of focus as we grow our businesses and build our brands. And LTV to CAC targets provide the guardrails for our investments in small business, while the consumer team focuses on a one-year payback. As for R&D, we benchmark our spending against other tech peers to make sure we've got the right amount of investment in innovation. This is a key element as we evolve into an AI-driven expert platform. Now, growth in R&D investment was a little slower in fiscal 2019, following the significant investments that we made in fiscal 2018. We continue to see opportunity in G&A to generate some leverage as we grow, and we're working hard to make sure we're best in class here. Now, there's always interest in where we're focusing our investment, so I'd like to go a little deeper in that area. At a high level, our approach has not changed. We invest in the highest yielding opportunities with a focus on investing to drive durable growth and accelerating speed and velocity, all within the context of our financial principles. And making deliberate trade-offs to allocate investment to the best opportunities remains a core element of our DNA. Looking ahead to this year, we will be investing in several areas to accelerate growth, which Sasan highlighted earlier. These include connecting people to experts, unlocking smart money decisions, being the center of small business growth, and disrupting the small business mid-market. Underpinning these is a focus on revolutionizing speed to benefit. In the future, we will be allocating more of our investment dollars into these areas to drive durable growth over the long term. This does not mean we won't continue to invest in core innovation and running the business. It does mean we will be very deliberate about what those investments look like. It's important to us to be effective stewards of capital. This includes investments in organic growth drivers as well as acquisitions to accelerate growth in talent and technology and to help fill out our product roadmap. Over the last 4 years, we've returned approximately $5.5 billion to our shareholders through share repurchases and dividends. We repurchased approximately $560 million in shares during fiscal 2019. And I'll touch more on repurchases in a minute, as this remains an important tool to return capital that can't be invested profitably in the business. As for dividends, our board declared a 13% increase in the dividend for fiscal 2020. And going forward, we expect our CapEx to remain at approximately 2 to 3% of revenue. Now, our philosophy and principles on share repurchases remain consistent with what we've shared in the past. That said, let me just quickly review how we manage the program. We limit repurchases to cash that can't be profitably invested in the business or used to make prudent acquisitions. We apply rigor to this process by utilizing a smart grid to drive various levels of repurchases at each price range, with a goal to exceed our cost of capital on average. At a minimum, we expect to offset dilution over a 3-year period and to be in the market each quarter. We're pleased to be guiding double-digit revenue growth for the company in fiscal 2020. We expect small business and self-employed revenue growth of 12 to 14%, and consumer revenue growth of 9 to 10%. This guidance is what we released back in August, so no changes here. We exited the year with strong momentum across our businesses, and we expect this to continue as we make our way through fiscal 2020. Here is our guidance for operating income and EPS. No changes here versus what we communicated in August. We're pleased to be guiding double-digit operating income growth, which is in line with our financial principle of growing operating income dollars faster than revenue. And we remain focused on making the right investments to drive durable growth across our businesses, and are pleased to do this while also growing operating income dollars faster than revenue over time. So in summary, we had a great fiscal 2019. We're set up to continue our strong performance for fiscal 2020 and beyond. Our focus on being an AI-driven expert platform unlocks opportunities to better serve customers across our businesses. And I look forward to connecting with all of you throughout the year and keeping you apprised of our progress.